Hi guys, welcome to the second edition of Let's Talk. This program is brought to you by the Surulere Archdeaconry within the Diocese of Lagos Mainland. Today we'll be talking about a very interesting topic, the comparative analysis of fixed deposits and the Nigerian Treasury bills. First and foremost, you would understand or you know already that the pandemic already caused problems for many nations, including Nigeria. It has changed the economic narratives of Nigeria, and for that reason, we are into a lot of rebuilding process. But then, before we go any further, I would want us to go through some times which I call the guiding times. The first one is the what I call time value of money, and which simply means that the value of the naira in your hand today will never be the same tomorrow. And the next one is financial intermediation. This simply means taking money from who has to the person who needs the money. And the next one is savings. It simply means keeping aside money for a future use, not forgetting investment. This simply means an asset that one acquires with a goal of generating income. We'll talk about consumption. Then this consumption refers to the purchase of goods and services for household. We also look at inflation and then inflation rates. Inflation refers to the sharp rise of prices, and we also look at inflation rates, the rate at which prices increase over time, resulting to fall in the purchasing power of money. We look at loans as well. Loans simply refer to the money borrowed, especially a sum of money that will be paid back over time with interest. Now, permit me to say this: whether you are looking at fixed deposits or treasury bills, one thing is very common: you are lending either to the bank or to the government. So, if you choose to lend to the bank or to the government, it's your choice. But then let's look at you wanting to lend to the bank first, and we are looking at you lending to the bank in the name of fixed deposit. So, what is a fixed deposit? You should know. I understand that I'll be talking to a lot of people in this conversation, not only people with finance background, but a whole lot of people that don't have finance background. They don't even know the ABC of finance. So I'll try to be I'll try to use the simple words that everybody would understand. So we're looking at fixed deposit to be a type of short-term financial investment sold by banks. Now, this investment that a bank will give to you, it's all about you fixing your money for a predetermined period at a predetermined rate. Now, you can also fix this money for a month, for 2 months, but it's usually within one financial year. So, what would make you want to invest your money in fixed deposit? Of course, there are a lot of reasons why you should invest the money in fixed deposit. But then let's look at the core features of a fixed deposit investment. The first one is that it's for a period of time normally, and it's sold by mostly by banks, and the interest rate is higher than other regular products like the savings account that the banks have. So we say that the fixed deposit is usually higher when it comes to rates, when it comes to the returns. The interest paid on the fixed deposit usually comes with tax burden, a 10% withholding tax. The depositor can decide to call back the fund, like, okay, you already have this deposit with the bank, and for one reason or the other you want this money back. Well, you can call back this money, but that comes at a cost. It means the interest that you would have earned, you have to forfeit it, and some banks may even go as far as charging you. We also look at the interest rates on fixed deposits, because it varies from bank to bank. It's subject to time. It's subject, like I said, time value of money. So the amount that you fix with the bank also is a determinant of the rates that will be offered to you by the bank. The bank actually makes money from this your deposit. They make money by lending it out to qualified clients. So the difference between the amount, the rate that the bank will give to you, and the rate that the bank will charge the potential clients is what the bank makes as profit. Then we'll also talk about the treasury bills. Now, the question you should ask yourself is, what is a treasury bill? What does it mean to buy a treasury bill? Now, like I said before, you either lend to the bank or you lend to the government. Now, if you're lending to the federal government, you're simply buying treasury bill. Of course, you cannot go directly to the government, to the president, and say that I want to buy treasury bills. No, you simply do that through the agents. Because the central bank offers these treasury bills, and the CBN also puts a limit on the amount of treasury bills it wishes to sell. The CBN uses this fund for various reasons. One of it is to control the inflation rate by trying to control the money in circulation at a particular point in time. The interest on treasury bills, you need to know, is paid upfront. Like, if for instance you're taking 91 days treasury bills, what they do is that they pay you the interest on it now. So at the end, at the maturity date, you will be paid the money that you already lent to them. So that way you would have enjoyed the interest upfront. um we also want you to know that the interest rate is determined by the CBN. And before they do that, before they tell you what the rates are, they also look at so many economic factors before they come up with rates. Let's look at the core features of treasury bills. So we say that the treasury bills um, is sold bi-weekly. It's sold bi-weekly and is determined by the CBN, like I said the other time. So the CBN puts a limit on the amounts that can be sold per time, per period. The interest on treasury bills, like I said before, is paid upfront. It's paid upfront. The CBN also, uh, like I said, from time to time they determine how much of it will be sold and when it will be sold. This is for economic reasons, for them to determine the money in circulation, the level, the volume of money in circulation, and also invariably that is to control the inflation rates. The CBN pays. Okay, go. The treasury bill is not secured by any asset or what you call collateral. No, um, it is a known fact that come rain, come shine, you would always get a money because you are giving to the government. You're not giving to an individual. So even if there is a change in power, even if we have a new president, it doesn't matter. Your money is still safe. Your money is still safe. So, but the question we should be asking ourselves is, should I go for fixed deposits or treasury bills? What are those things that will make you consider the fixed deposit or otherwise? Now we look at the four items. We look at what we call risk, which I already defined in the first slide to be the difference between what you expect and what you actually got. We also look at interest rates. Then we look at the tax implications and then liquidity. When you talk about risk, the treasury bills are backed by the full faith of the full faith and credit worthiness of the government, and as such they are seen as um, the most risk-free asset, most risk-free investment. But then the interest rate cannot be compared to that of fixed deposit. But bear one thing in mind: because of the pandemic, like I said before, the it has changed the economic narratives. You may not be able to get the kind of interest rates, whether fixed deposit or treasury. You may not be able to get the kind of rates that we used to get in the past because of the stark realities of the economy. The fixed deposits are also backed by the credit rating of the bank. Of course, the bank will not give you a collateral, but then one thing you should know is that should the fixed deposit go down, should the bank go down, your money or part of your money or the whole of your money may be gone. So these are the things you consider when it comes to risk. So in this case, if you are the person who is so concerned about risk, then maybe you should just think treasury bills. Also know that some persons the reasons for investment differ from person to person. There are some persons that invest just because they want additional income. They want income appreciation. Some persons actually invest. For them, it is a way of saving. Like, oh, I don't want to touch this money. Let me fix this money and forget about it. So if you are that kind of person that you are not so keen on the interest or the income you generate, of course you can think TB, that's treasury bills. Then we look at the tax implication. You need to know that for that of treasury bills, the government does not charge you tax, what we call withholding tax, but then you may still be charged service fees by the bank that is rendering the service. Unlike the fixed deposit, whatever you make on top of the money you would have fixed is subject to a 10% withholding tax. So these are the things you think you look at before determining which you go for. Now, don't forget that there are other investment options, but for the sake of this conversation, but for the sake of this discourse, we will limit our investment options to fixed deposits and treasury bills. Um, can I use my fixed deposit or my treasury bills as a collateral? Of course, yes. The truth is, you can use the fixed deposit as a collateral for a bank loan. Some persons actually do this. They have a bulk money and they don't want to spend it. They just want that money to still be there. But then they may have urgent need for something, and they go to the bank. Of course, sometimes when you go to the bank would require you pledge hard collaterals, and you may not have it at that point. But with your treasury bills, of course, you are good to go, even with your fixed deposit. But then some banks may consider the bank or the financial institution where you have the fixed deposit, they consider their credit rating. If their credit rating is poor, they may not consider that as sufficient collateral before giving you the loan. Another thing we can look at is the option of rollover. With the treasury bills, you are not permitted to roll over your treasury bill at the point of maturity. The bank will simply credit your accounts with the initial capital layout, the initial principal that you must have given out. Remember, you have been paid the interest upfront. But that of the fixed deposit, at your request, the bank would simply roll it over. Of course, that will be the banker will be glad to roll over your fixed deposit. So these are the little things that we consider before we venture into fixed deposits or the treasury bills. But then you also know that Now, for treasury bills or for fixed deposits, one thing is common: you are lending to either the bank or the government. Which one pays more taxes? Treasury bills are exempted from taxes, like I said before. You are not permitted to pay any tax, but then your service provider, that's the bank that is rendering the service, may charge you a token for rendering the services. Unlike the treasury bill, unlike the fixed deposits, where it is subject to 10% withholding tax. So whether fixed deposit or treasury bills, one thing is common, one thing is certain: you must set aside money before you can invest. So you first of all talk of investments before you talk of savings before you talk of investment. So whichever one you want to go for, just know that one thing is underlying: you must check these risks. You must check out for the risk, the interest rates, the liquidity of the company, of the bank that you're investing your money into. So these are the things that you may not be able to determine on your own. You need to engage the services of a financial expert. I hope this discussion will be very useful for you as you plan to invest either in fixed deposits or treasury bills. Thank you very much.